Hello, and welcome to another session of Reflections on Investing by the Cornell Capital Group. The subject of today's talk is leverage. Now, you might think with interest rates very low and stock prices continuing to climb, a lot of investors would be borrowing money in order to invest in the stock market. That's called leverage. And there's indirect ways to get leverage as well, not only by borrowing and buying stock, but by trading derivative securities, in particular options. So let's take a look at the role that leverage might be playing in today's market. And let me start with a chart here from John Hussman, who's a well-known portfolio manager. And what Mr. Hussman tracks is the ratio of margin debt, that is the amount of money borrowed to invest in stocks, against the GDP, the nominal dollar GDP. And if you look at this, you see here it's running at a ratio of about, excuse me, let me get my pen working here. It's running at a ratio of about 0.5 throughout the 80s and early 90s. And then as the stock market takes off, as we get into the dot-com boom, that ratio goes up from about 0.5 to over 2.5. So it increases 5 times. When the dot-com boom explodes, it drops back to about 1. And then it runs up again during the housing boom to about 2.5. But now it's at an all-time high. It's over 3.5, 7 times higher than it was during the early 80s. So it's consistent with the view that people are borrowing money to invest in the market. And those who have done very well. But like everything else with investing, there's a plus and there's a minus. So let's dig a little deeper. This next chart is it's the so-called Buffett indicator, because Mr. Buffett liked to track the ratio of the value of the stock market to GDP, the productive power of the economy. And the version we're using here is the ratio of the Wilshire 5000, which is basically the value of all American traded stocks, to GDP. And you can see back in the early 70s, it was about 80%. During the dot-com boom, it got as high as 136%. In the housing boom, it got to 105%. And it's currently 185%. So stocks are worth far more compared to GDP than they ever have been by a large margin. And part of that is because of the leveraged buying. Now, I said there's a good side and a bad side. Let's take a look at a simulation that Andrew Cornell of Cornell Capital Group did. And that's here. You might recall that we discussed earlier the Cornell Capital Group Unprofitable Index. This is an index of highly innovative, attractive companies that have run up a great deal, even though they've not made a penny in regular GAAP earnings. Those would be companies like Snap and Lyft and so forth. Well, what Mr. Cornell has done here, he's compared two investment strategies. The investor starts with $10,000. In the first strategy, the investor takes that $10,000, borrows another $10,000. That's the most you can borrow against stock. Your equity, your borrowings can be no more than 50% of your equity. So if you take $10,000 in cash, put it in the market, borrow another $10,000, put it in the market, you have $20,000 in stock and $10,000 in debt, and you just meet the requirement. So the red line here in his graph, that's all you do. You take your $10,000, you borrow another $10,000, You put it in the CCG unprofitable index, and you just leave it there. And you can see that because these unprofitable companies have run up, it goes from about 20,000 at the start to 80,000 or so at the end, at the current date. Now, the blue line is a strategy where you originally invested $20,000. If the market goes up, you can borrow more money because your equity's worth more. So you borrow more money and invest that. Whenever the price goes up, you borrow the maximum amount you can and invest it. Of course, that means when the price goes down, you have to sell stock in order to meet the margin requirements of the 50%. And this is going to magnify the move substantially. In fact, incredibly. As you can see, the blue line gets as high as almost $350,000 from an original investment of $10,000. But it crashes back to 100. But nonetheless, as of the current date, it's at about 185. Far better than the unleveraged one. But you can see the impact of the leverage. When things go very well, it's pronounced on the upside, and when things go poorly, it's pronounced on the downside. And that should be a bit of a warning because prices are very high now. Borrowing is very high. There may be a lot of people who are highly leveraged, and if prices start to fall, they'll have to sell, and that can lead to a downward spiral. Now, there's one other way to get leverage. There's many other ways, but there's one other important one in today's market, and that's to use options. Rather than putting your money into the underlying stock, you put it into an option. And to show you how much more variable the option can be, we took a look at Tesla. So this is an investment starting in November of 2020, going through to the present day. And the red line shows your percent appreciation if you'd bought Tesla stock. Because Tesla did well during that period, you're up about 80% if you just bought and held the Tesla stock. But if you went into the Tesla 700 call options, and later I'll explain more of what those call options are. Look it up if you're not familiar. I don't want to spend too much time on options today. But if you bought with that same amount of money, the Tesla 700 call options to expire July 16th, which is this Friday, your profits, depending on the time, you could have been up over 1,200% at one time. But the options are very sensitive in both directions, and they tend to decay over time, so that as of right now, because Tesla's well below 700, those options are almost worthless. So you went from a profit of over 1,200% to a loss of basically 100% in the course of less than a year. That's the impact of the leverage involved with options. So what's the bottom line of today's session? The market is highly levered now. There's a lot of young people trading in the options. There's record borrowing against stock. All that works great when the market's going up, and it's been going up. But if it were to turn, it could exacerbate moves on the downside, and that's something to bear in mind. This has been Reflections on Investing.